Well, good afternoon and welcome to HIROC's weekly webinar where we will talk about what we see happening in the global economy, financial markets, and the world of wealth management, and how all of this impacts our decisions on the best courses of action for our and your investment strategies. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. I'm Scott Tomlinson, and I'm joined by my partner and colleague, Paul Tepsich, the founder of HIROC, who does some tremendous bottom-up research for our tactical model and has been quite astute with a few of his value picks so far this year. Our financial planner, Bianca Tomlinson, is also on the call. We will have a question and answer period at the end of the call, so if anyone has a question about any aspect of wealth management, we invite you to feel free to ask us questions. And if you have joined the call, I just remind you to all please, if you could, keep your microphones on the mute. Thank you. Well, if you are a listener for the first time and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the private client division tab. Well, as we do each week, let's quickly recap our themes for 2016 before we get started on what has happened over the course of the last week. Now, our overriding theme for 2016 is that financial markets will remain volatile. January and February, early February, saw a spike in volatility, but markets did settle after that, thanks to continued central bank monetary stimulus. But now volatility is back in the picture as uncertainty levels are rising on a global scale with the debate over the fallout of the Brexit vote in the UK. Now, the U.S. economy represents 20% of the global economy, and over 50% of the companies in our benchmark equity index are domiciled in the U.S., so we spend a good deal of our efforts trying to determine how the U.S. economy will evolve. The heightened level of uncertainty hanging over the global economy at the moment has increased the chances of a global recession. And that could well be a catalyst that drags the U.S. economy down with it. Low inflation and deflationary pressures will likely continue until economic growth can return. The stimulative central bank monetary policy on its own has not been successful in reigniting global economic growth. Certainly, geopolitical uncertainty has taken center stage. The fallout from the Brexit referendum and the rise of populism in developed nations, and especially the United States, will hang over economic decision-making for the time being. There has been a flight of capital into safe government bonds, and bond yields are currently hitting record lows. And equity market prices fell initially and then bounced back following Brexit, comforted by the greater possibility of more central bank monetary policy stimulus to combat the impact of additional volatility. However, they remain expensive in terms of earnings and valuations. The price discovery and volatility will continue until a reasonable equilibrium is determined, but our comfort level with this asset class remains very low at this particular time. With no clear economic direction, businesses will tend to postpone investment decisions and consumers will postpone spending decisions until they can get a better sense of what to expect in the future. This does not make for an environment that might offer solid investing returns. However, there may well be a time in the future when more reasonable values will offer good investing opportunity, and we should and will be prepared to take advantage of those. Okay, well, let's have a look at what's been driving markets over the course of the last week. Needless to say, as we had projected, volatility spiked back to the levels that it was at in January and February. We think there will be more spikes to come in the not-too-distant future. And volatility, however, has moved back below, at the current levels, back below its long-term averages. The fear and greed index has actually recovered back into greed territory. Last week at this time it was sitting at neutral. Well, for us, the best time to buy is when markets are afraid, and we will be patient to wait for that situation to occur once again. So as we have been still sitting on the sidelines with plenty of cash in our models and in our client portfolios. Well, since our last webinar, our benchmark world equity index is up by about 2% and is now down about 0.5% on the year. The UK FTSE 100 was the best performer since last Tuesday. The German Xetra DAX index was the worst performer. The TSX has been the best performing country index in the developed world this year. The Japanese Nikkei 225 has been the worst performing index. While the longer term downtrend continues for our benchmark all country world index, lower lows and lower highs with the next test of buying support likely somewhere down along that bottom channel trend line, a little over 15% lower, and then that takes us close to that 45 level. Volume spiked following the Brexit decision with a 5% sell-off, but in the ensuing bounce, volume has been quite low. We always believe that volume is a key direction indicator, and we'll monitor that very closely as we move forward as well. Now, the one-year total return on the benchmark all country world index has been a negative 4.31%. The three-year annualized return has been a positive 5.79%, and the five-year total return about a 5.12%. Now, if you combine the equity and bond indices into a balanced scenario, the one-year total return has been a negative about 1/3% for a 60% equity and 40% bond index combination. A positive 5 3/4% over 3 years, and a little over 5% for 5 years. A less risk-oriented 40% equity and 60% bond combination for the one-year total return, we've seen about a 1.68% return. The 3-year return is a little under 5 3/4, and the 5-year return just about 5%. Interestingly, the 60% equity and 40% equity returns over 5 years have been pretty much in the same ballpark. When you are comparing the return on your respective portfolios, don't forget to include any fees and embedded MER costs. Well, fixed income indices continue to move higher over the course of the last week. Record low bond yields in 10-year government bonds, with the U.S. at 1.37% and in Canada actually a little below 1%. So that will keep longer-term rates down, especially mortgage rates. So if anybody is looking at extending their terms for mortgages, it may not be a bad time. However, keep an eye on it, because if things continue the way they have been, we could even see lower rates going forward. Gold was up this week and oil was down, similar to what had happened over the previous week. Oil is testing the lower band of its recent uptrend channel, having been unable to recently stay above that $50 level. It may well go back to test that 40 level if it breaks through that lower band. Well, the Bloomberg Commodity Index continues its new uptrend, but is off its recent highs. The broad and diversified benchmark equity index, upon which we gauge the performance of our model and portfolio performance, covers close to 2,500 companies domiciled in 23 developed countries and 23 developing economies. As a result, we watch closely how the key component countries' economies are evolving. However, it is also important to remember that many of these companies have a global perspective, so we also need to keep in mind that it is the companies that we are investing in, not necessarily the countries. With over 50% of the companies in our benchmark domiciled in the U.S., as I said, we keep a close eye on what's going on in the U.S. First to the political stage, where we find that Clinton has given up some ground to Donald Trump in the post-Brexit period. However, today news came out that the FBI will not be prosecuting Clinton with regards to her email situation when she was Secretary of State. That may, in fact, be a positive going forward for Clinton. We'll see next week how that turns up in these results. Well, 3 weeks ago at their meeting, the Federal Open Market Committee members indicated that their expectations for future interest rate increases had further scaled them back. March's dot plots are on the left, June's are on the right. With the increased levels of global uncertainty and volatility, this may keep them on hold even longer. It is our belief here at High Rock that an increase in interest rates in any manner will likely flatten the yield curve and fuel the next U.S. recession. When faced with increasing levels of uncertainty, the first thing that businesses do to protect themselves is to cut costs. The fastest and easiest way to do that is to decrease the costs of employment by letting workers go. And that is why unemployment rates jump prior to a recession beginning, as we see has happened historically. This Friday, we will get the latest unemployment and employment statistics for the month of June. It will likely not be as important because the post-Brexit data will not come until August and September. So we'll, of course, continue to watch that data very closely. For the second quarter, GDP expectations remain a little over 2.5% as of the latest reading on July 1st, with a decline expected, with declines in residential investment growth. Elsewhere in the global economy, of course, Brexit and the potential political and economic fallout continue to dominate the financial media. Unfortunately, it may take some time yet to determine what exactly will be the end result, but until then, there will certainly be plenty of speculation and uncertainty. As was expected with the Brexit result, the British pound fell off of a cliff, and it keeps falling despite a slight bounce last week, but back to record lows, down now over 13% from pre-Brexit levels. Well, following the referendum, the Standard & Poor's rating agency lowered the rating on UK government debt to AA from AAA, based on a projection of economic growth lowered to a GDP of about 1.1% from the previously expected 2.1%. Today, at a press briefing in London, Bank of England Governor Carney, following the central bank's semi-annual financial stability report, he said that there is the prospect of a material slowing of the economy. The number of vulnerable households could increase due to a tougher economic outlook. While global growth across all economies, estimates are now being revised lower, and that can be certainly seen in this particular chart here, courtesy of the Wall Street Journal. As far as the Eurozone is concerned, pre-Brexit, private sector companies in the Eurozone ended the second quarter on a bit of a disappointing footing. According to the latest Purchasing Managers Index, a well-respected survey of activity, an improvement in the Euro area's manufacturing sector was outweighed by slowing growth in services. Chris Williamson, the chief economist at Market, which compiles the PMI surveys, believes second quarter GDP growth cooled significantly to 0.3% from 0.6% in the first quarter. Meanwhile, Italian banks have come under extreme selling pressure as they suffocate under a large amount of non-performing loans, threatening to pull Italy's banking sector into crisis. This could have a contagion impact for all of Europe and potentially beyond. Japan has emerged also as a victim of the fallout from the UK's vote to leave the European Union, with Prime Minister Shinzo Abe's government and the central bank facing the most serious crisis yet in their 3.5-year campaign to revitalize the economy. The Bank of Japan had already been struggling to bolster the economy through measures that relied heavily on cheapening the yen to support corporate profits, much of which are earned abroad. The UK's vote to leave the EU sent the yen soaring as investors poured money into currencies seen as stable stores of value in times of turmoil. So flight to quality pushed the yen to to levels that it hasn't seen in significant amounts of time. Well, in Canada, after decreasing in February and March, real gross domestic product edged up 0.1% in April. Gains notably in manufacturing, utilities, and the public sector were largely offset by significant decline in non-conventional oil extraction. And not good news from the Bank of Canada's Business Outlook survey released yesterday, suggesting subdued overall business sentiment. Well, not much good news on the global economy front, as I've just finished mentioning. Let's check and see what bond markets are telling us, because they do tend to lead other markets. Well, not only did bond yields continue to make record lows this week, but yield curves globally continue to flatten, indicating that the probability of recession is growing in each of these respective countries. Yields in Germany are now at or below zero out to near 20 years, and almost all yields in Japan are zero or very close to it. This certainly does not paint a good picture for the future. Well, as for equity markets, according to the Wall Street Journal, suggested in a headline today, the stock markets are not paying attention to what bond markets are forecasting. And our concern here is, of course, as we've said week after week, when investors buy stocks, they buy a stream of future earnings. Now, the price-to-earnings ratio represents a metric to measure stock prices relative to earnings. The 10-year average price-to-earnings ratio is sitting at 14.3 times, but the 12-month forward price-to-earnings ratio is currently at an expensive 16.4 times, up from 16 last week and down from 17.1 at the equity market highs back in May of 2015. Well, not only are prices expensive relative to earnings, but there have been 4 consecutive quarters of negative earnings growth, and expectations show that the second quarter will likely be the 5th, with expectations showing a negative growth rate of minus 5.3%. And earnings growth for all of 2016 will be close to 0.5%. So it is certainly hard to expect growth in equity markets when companies cannot grow their earnings. Furthermore, as we've been mentioning on numerous occasions, central banks that bought bonds through the quantitative easing process added assets to their balance sheets, which is that white line that you see. And during this process, stock markets were given a false sense of buying power with the additional monetary stimulus, and investors pushed stock prices higher as they replaced the bonds that the central banks had bought with stocks. Without any recent bond purchase, the S&P 500 has been unable to generate any new highs. And keep in mind that when investors borrow to invest, it historically pushes stock prices higher. However, when they reduce borrowing to invest, the opposite occurs, and they sell stocks to pay down their debt, which is certainly what is happening now, is similar to what happened back in 2007, and certainly did not bode well for what occurred in 2008. So something, again, that we're keeping a very close eye on. What does it all mean? Well, for well over 1 year now, we have taken a cautious and defensive posture to investing, and it has been fortuitous for our clients and for ourselves. Remember that we are investing in the exact same models and securities as you, our clients, do. We remain defensive because we see few, if any, good buying opportunities at the moment. And we monitor a great many metrics that help us to determine where there might be some value, but until we are convinced that there is value, we will remain cautious. With increased levels of uncertainty arising from the Brexit referendum, we are in no hurry to take added risk unless we see reasonable opportunity. Cash and cash equivalents have been and continue to be important defensive assets, so we are still carrying greater than normal cash balances in our models. If we can attain better than benchmark returns, having more cash and less exposure to risk, we are therefore attaining the best risk-adjusted returns. Now remember, the core of most client portfolios is a long-term strategy based on your personal wealth forecast, your goals, your risk tolerance, and your time horizons. However, the ongoing research and analysis that we do at High Rock will dictate the minor adjustments in short-term strategy that we make in our models, which we believe will add value to the long-term performance. Rebalancing on a regular basis is crucial, and this is something that we meet to do each week to identify which client portfolios are further away from their intended allocations and make the appropriate adjustments. Different asset classes will outperform or underperform at different times in a market cycle. Selling those outperforming assets that become overweight and buying underperforming assets that become underweight will continually add value and enhance returns. Underperforming assets will eventually return to better performance, while outperforming assets will ultimately underperform as we move through the cycle. This is how profitability is realized and new cash is reinvested. We also analyze each asset class to ensure that it is appropriate for each client's strategy. Our ultimate goal is to get the best risk-adjusted returns that are available for both our clients and, of course, for ourselves. Well, on BNN's market call back in May, Paul identified 3 top picks for our models. One of those was 30-year Government of Canada bonds. Prices spiked post-Brexit, and Paul's purchase idea is now up about 9%, 9% since May. Annualized, that is better than a 50% return. Good pick, Paul. Paul also wrote an interesting blog this morning on identifying problems before they actually blow up. Paul, would you care to elaborate on this?
Sure, thanks, Scott. Yeah, just yesterday and today there was news coming out of the UK that started with Standard Life. They have an open-ended fund, I believe. Aviva has a closed-end fund, and M&G, I'm not sure whether, I assume it's an open-ended fund, but nonetheless, they're all effectively commercial real estate funds, and they've been what's called gated. A gate is something typically you see in hedge funds that run into liquidity trouble, i.e. all the investors try to run through and sell and run through a really small window of opportunity to sell, and the fund can't possibly, I mean, as you can well imagine, commercial real estate is extremely illiquid. The fund cannot actually redeem any of those units from the sellers, so they just gate it. They disallow redemptions or selling of any sort. So when you see this happen, it's never a good thing, and as I wrote in the blog, I sort of lived through this in the summer of 2007, and quite frankly that we saw 2 Bear Stearns hedge funds that were filled with CDOs or collateralized debt obligations, and they were filled with residential mortgages in the U.S. And then we saw Coventry in Toronto, which was really the harbinger of the credit crisis as we know it. That was sort of the beginning of the end, if you will. So I think this is not a good sign for Europe, and as Scott, as you mentioned, Italian banks have been getting annihilated over the past week, and that's a really interesting story as well, because if you dig down over the past week, we find that all systemically important banks are supposed to follow Basel III rules, which require if they run into liquidity problems and trouble, governments are not supposed to bail them out. In fact, all of the bonds of that bank, the senior parts of the capital structure of that bank, are supposed to what's called bail in to common equity. But apparently Italy doesn't want to do that. They would rather fund a 165 billion euro program where they provide support to their banking system. So there's going to be, certainly late last week, that ruffled the feathers of Angela Merkel. If the Italian government is yet going to take down more debt, that may be her issue. So we'll see what transpires with that. But certainly the banks in Europe, there's going to be a complete and utter chain reaction of issues.
I have a quick question for you, Paul, just on that, the idea of chain reaction and contagion, because certainly that was something that was very significant in what happened in the financial crisis in 2008, is that money dried up. I mean, all financial institutions, for the most part, were subject to huge squeeze on capital. And is this something that we need to be pretty careful about going forward?
Well, yes. The central banks, both the Bank of England and the ECB and the Fed, have said they will put liquidity into the system, which is helpful. But the real problem is, I don't even think the regulators know what type of risk-weighted assets all of these banks hold. And we've gone through effectively, it's called 7 years of falling rates and a flattening yield curve, and those are two things that hinder bank profitability. So they're way bigger today than they were back in 07. So they have a lot more assets on their page. So the real risk is what's called counterparty risk. So that's where one commercial bank is lending to another commercial bank, and that's exactly what happened back in 07 through 08 here, well, around the world. So it's really counterparty risk that is the issue. Liquidity helps, but if there's counterparty risk, it gets to be really problematic.
Yeah, because they just stop lending to each other, right?
Well, yeah, and then the central banks step in and try to put a little bit of liquidity in, but it's just not enough. So I think that's the real risk. And some of the metrics that I watch on some of the European banks, like credit default swaps and whatnot, which are derivative instruments we certainly don't invest in or trade, but they are leading metrics that we can track what's going on in some of the banks around the world, and they certainly have been weakening dramatically. I think a lot of it is going to be counterparty risk. Scott.
Excellent. All right, just so everybody's aware too, Paul often will write some of his interesting perspectives on a blog each morning, and these can be found on our HighRock website. Thanks, Paul. Okay, and as we do each week, we just have a look and see what kind of information is coming forward over the course of the next week. A lot of this information, I will say, a lot of the data and statistics is pre-Brexit. So most of the data that we're going to be we're going to find more crucial will be data that comes post-Brexit, which gives us a little better indication of what the general market sentiment or the economic sentiment has been since then. So nonetheless, let's just have a quick look through. Tomorrow we're going to hear from the U.S. Federal Reserve, the meetings of the minutes from the latest FOMC meeting, give us a little more detail on their thought process and what they're thinking as far as the U.S. economy and interest rates are concerned. We'll get some May industrial production numbers out of the U.K. on Thursday. Importantly, I think we're going to see the June foreign exchange reserve numbers from China. That could, in fact, give us some clues as to how much the Central Bank of China has had to inject into the system post-Brexit, if there has been any concerns there. Friday, we'll see employment data both in the U.S. and in Canada. Historically, those are pretty major economic indicators, but as I said, this is going to be data pretty much pre-Brexit, so not as potentially impactful. Next week, we'll see some trade data from China, and of course, as we do each week, we'll have the HighRock webinar on Tuesday. Okay, well, that's it for today's discussion. If anyone is listening might have a question, this is your time to come forward and ask. All right. Well, for those who are listening and do have questions but would prefer to email us, more than acceptable. We love to get your input and feedback. And of course, for anybody listening to the recorded version, same idea. Please feel free to get in touch with us if you have any questions or want anything specific to be discussed on these calls. It's always great for us to get an idea of what people want to hear about. But as always, thanks for taking the time to tune in. Have a wonderful rest of the week and a great weekend coming up. Don't forget to tune in next Tuesday. But until then, this is Scott Tomlinson signing off.